Have you ever watched a chart and wondered, why does the price keep stalling here or bouncing back there? It often feels like the market has a memory, and in a way, it does. The key to decoding this lies in two of the most foundational concepts in technical analysis: support and resistance. Think of them as the floor and ceiling of price movement. In this video, we're going to demystify these concepts. We'll break down exactly what they are, how to spot them on any chart, and, most importantly, how you can use them to make more informed trading decisions. Whether you're a complete beginner or looking to solidify your understanding, stick around. Let's start with the basics. Support is a price level where buying interest is consistently strong enough to overcome selling pressure. It's like a floor. As price falls and approaches support, buyers step in because they perceive the asset as being at a good value. This increased demand causes the price decline to halt and often reverse upwards. It's where the market has historically said, enough is enough, it's cheap here. Resistance is the opposite. It's a price level where selling pressure overcomes buying pressure, acting as a ceiling. As price rises towards resistance, sellers become active, they think it's overvalued or want to take profits, and this increased supply stops the rally, often pushing price back down. The market is saying, it's expensive here, let's sell. Here's the crucial psychological element. These levels are not magical lines drawn by the market gods. They represent areas where a large number of traders have made decisions in the past. At support, buyers who missed the last bounce are waiting to buy. At resistance, sellers who regret not selling last time are waiting to exit. It's a self-fulfilling prophecy based on collective market memory. Now, how do we actually find these levels? They aren't always perfect horizontal lines. We look for areas where price has reacted multiple times. The more touches a level has, the more significant and reliable it becomes. Method 1. The horizontal line. This is the most common and powerful method. You connect significant swing lows for support and significant swing highs for resistance. Don't force it to be an exact price. Think of it as a zone. Price may wick slightly through the line before reversing. That's normal. Method 2. Trend lines. In a trending market, support and resistance can be diagonal. In an uptrend, you draw a trend line along the rising swing lows. This is dynamic support. In a downtrend, you draw a line along the falling swing highs, dynamic resistance. A break of this line can signal a trend change. Method 3. Trading ranges and consolidations. Sometimes price moves sideways between a clear support and resistance level. This is a range-bound market. Traders often buy the support and sell the resistance until one side breaks. And here's a critical transformation: role reversal. When a strong resistance level is decisively broken, it often flips and becomes new support. Why? Because the sellers at that level are now gone, and buyers who bought the breakout see a pullback to their entry as a new opportunity. The same happens in reverse when support breaks. It becomes new resistance. Knowing the levels is one thing, trading them is another. Let's discuss 3 common approaches. Remember, this is for education, not financial advice. Strategy 1. The bounce trade. This is the classic. In a range-bound market, you look for price to approach a proven support or resistance level and show signs of reversing. At support, you might look for a bullish candlestick pattern, like a hammer or engulfing pattern, as your signal to buy, with a stop loss below the support zone. Your profit target is the opposite boundary of the range. Strategy 2. The breakout/breakdown trade. You anticipate that a key level will fail. You don't buy or sell at the level. You wait for price to close convincingly beyond it. For a resistance breakout, you might enter on a strong bullish candle close above the level, with a stop loss below the breakout point. The strength of a breakout is often judged by an increase in volume, but beware of the false break or fake out. This is when price briefly spikes beyond a level only to snap back. This is why many traders wait for a retest after a breakout. Strategy 3. The retest trade, the poor man's breakout. This is often a safer, higher probability entry than chasing the initial breakout. After a level breaks, you wait for price to return to that level. The old resistance now becomes new support, or vice versa. If it holds on the retest, That's your confirmation to enter in the direction of the breakout. Your stop loss goes on the other side of the retested level. Mastering these concepts takes screen time. Open a chart, start drawing these levels on historical data, and see how price respected them. Then practice in real time with a demo account.